We're back with the India development debate, and we were in conversation with Railways and Coal Minister Piyush Goyal. Now let's take the debate forward on the S&P assessment of the Indian economy. Who's right? Is it the Moody's whose assessment is reflective of the situation on the ground, or is it S&P who seems to have a better sense of what's going on in the Indian economy? Let's take that discussion forward. Joining us on the show this evening, Ravi Bhatia, Director S&P, joins us from London. Maithili Bushnam, Consulting Editor, ET Now, and Anand Narayan, market expert, joining on the show this evening. Ravi, I'm going to start off with you. A very simple question, really. Why is S&P being so conservative in its outlook and rating on India at a time when Moody's has upgraded its ratings? What is it that Moody's has been able to see that S&P hasn't? Because this comes despite a slew of reforms undertaken in India since 2007, which is when when you last rated. So from then to now, we're rated in the same grade as we were in 2007, despite a slew of reforms undertaken, and our rating is just one notch above the investment grade.
Well, I mean, we've balanced the country's strong GDP growth and strong external record and improving monetary framework. I mean, those are broadly the strengths against our sort of broad concerns, which are the fiscal and the debt stock remains very high. And GDP per capita, despite the strong growth, is still very low. So if you combine these factors as per our criteria, I mean, we have affirmed the rating and maintained the stable outlook. Also, while the growth trajectory has been, in the medium term, looks good, we've also seen a couple of quarters of wobbly growth at the moment. I mean, partially tied to teething problems around the implementation of GST and the demonetization, which happened earlier. But basically, it's a combination of those factors, and so we view the outlook as stable.
Maithili, coming on that, I do want you to, do you have a counterpoint of view? I mean, do you believe S&P is being way too conservative? The whole fiscal profile obsession that S&P seems to have, at least over Moody's, what's really your take?
Well, I would certainly think they're being far too conservative, Supriya. Apart from the fact that, of course, ratings are always subjective, there is an element of subjectivity, and very often there is a very strong political element also. Because let's not forget, like a country like the US, immediately after the global financial crisis, when S&P in fact downgraded the US rating, the US government, courtesy the SEC, took very strong action against the SEC, which was then headed by an Indian American. So these are very strong political voices also. So even assuming that this is not a political take and this is based only on the basis of numbers, if you look at the numbers alone, between 2007, which was when the last rating was done, and now, look at our fundamentals. The fiscal deficit was much, much higher. The debt was roughly in the same range, mid-60s. We've always been in that range. And unlike many other countries, our debt is almost entirely domestic debt. That means the government has complete control. In the worst case scenario, you can always inflate away your debt. So not only is our debt very reasonable, well in the mid-60s, much, much below those of countries which have much higher ratings than us, whether it's Japan or the US or Italy. So our debt position is entirely satisfactory. Not only that, if you remember, even in terms of debt sustainability, to the extent that our nominal GDP growth has always been in excess of the nominal rate of interest paid on our debt, there is no question really of a debt trap. And as for the third factor that the rating agency points out, S&P, that the per capita income, well, obviously in a country like ours, where you have such a large population, the per capita income is low. In fact, many people perhaps would credit us, say that you have a demographic dividend, because that's what a large population does. We have a large young population. So you could easily look at it as a plus. And if you look at the overall GDP in per capita terms, purchasing power per terms, we are the third largest economy in the world. So it's all a question of how you look at it. So for whatever reason, S&P has opted to play a very, very conservative view of the situation. But I don't think one should get bothered too much about it, because at the end of the day, what matters is how seriously do the markets take these ratings. And if you look at whether it is foreign direct investment or foreign portfolio investment, markets certainly don't seem to take very much credence to S&P's rating, because we have seen FDI, gross FDI, the highest perhaps in many, many years.
Right.
FII, we've got dollars coming out of our ears. So what matters ultimately at the end of the day is how seriously do markets take the rating, and there the answer is not at all.
All right, Maitri, you've raised some very good points, and we will, debate that with the S&P as well. But I want to get a quick word in from Anand. Anand, whose assessment are you likely to go, to favor the Moody's assessment of the economy or the S&P's? Do you feel S&P is being too conservative, or do you think Moody's is being too optimistic at a time when there are macroeconomic headwinds, current account deficit is shooting up, inflation not quite under control, concern on the fiscal deficit? So do you think Moody's is being too optimistic, or is the S&P being too conservative, like Maitri points out?
Well, I'm going with the Maitri view, which I really like, which is the market is number one, and then we'll worry about the other rating agencies later on. No, but jokes apart, this is a fact. India, for a variety of reasons, and possibly because we also have a scarcity value, given that our sovereign doesn't really issue bonds as such, has always commanded credit spreads tighter than what you would expect compared to our peers who have the same rating as given to us by Moody's or by S&P. So historically, while Moody's has been a little more kinder to India than Fitch, and which has been kinder than S&P, across all these three big rating agencies, the actual market spreads commanded by us in the international credit markets have been a lot tighter and comparable to peers who are 2 or 3 notches higher than us. In fact, as we speak, the credit spreads for Indian paper are at all-time lows. It's also true that there is this wall of liquidity which has impacted paper across the globe, not just India. But specifically, Indian paper is going at amazing spreads. We saw the Reliance bond coming out at an extremely low spread just a few days back. In fact, Indian paper is going lower than Korean paper, comparable paper, and Korea is actually an A-rated name. So market clearly has its own valuation and looks at its own dynamics. Having said that, there's a clear utility of having these rating agencies. One, it's a nice, independent, objective review of life, and it shows us a mirror in front of us. And B, more importantly, a lot of real investors do look at these ratings, S&Ps and Moody's and Fitch, to figure out how much of allocations they need to give to India as a country, for instance. So clearly, from a real flow perspective, it's pretty important. Now, while historically rating agencies have been a little more conservative when it comes to developing countries, including India, I think in terms of the timing right now, you could raise a bit of question. The reality is, if you take the historical conservatism for granted, at the current moment, there is a fair degree of uncertainty on our fisc. There is fair degree of uncertainty on how our NPA situation will resolve itself. For the first time, the current account deficit is raising a couple of eyebrows, especially with oil prices going awry. And of course, the overall inflation, how do rates go from here, etc., is also a bit of a question mark. So in terms of the timing, frankly, I think there is a bit of question mark about the Moody action. To that extent, at least S&P has a little more been consistent in their action.
Okay, so S&P perhaps more consistent in their action is the word that's coming in from Anantarayan. But Ravi Bhatia, you spoke about low GDP per capita, and that's of course been one of the reasons why you haven't upgraded India, and that's a big bone of contention here in India as well. But the government saying that it's perhaps unfair to evaluate a country as sovereign like India on the basis of low per capita income, because it's a developing country, and cites the example of Indonesia, which was upgraded 7 times between 2002 and 2011. So for those 9 years, even though it had a per capita GDP of a little above $1,000, whereas we are inching closer to $2,000 in India. So how would you explain that disparity then?
Well, I mean, it's a combination of factors. So you could say, I mean, the very high growth rates that India is seeing are possible at this low level of GDP. And we give India credit for the very rapid GDP growth. And then, of course, when we look at the external, India is looking increasingly strong. The reserve numbers are really quite strong, and it's more than 6 months of import cover. So on the external accounts, India is looking strong. And then institutionally, there are good checks and balances. Broadly good on that front as well. So it's a combination of factors. But I mean, there's no getting away from it that when we look on a comparative basis against all the other countries, pretty much all the other countries in this BBB minus category, India has the lowest GDP per capita. And that's, so that's what on a comparative basis what we see.
Maitri, does that comparative basis hold? The fact that among all countries with who are one notch in the investment grade, India has the lowest per capita GDP. Does that hold at all? And this isn't just an S&P problem. This is an issue with most rating agencies who have this skew against developing countries like India when it comes to measuring per capita GDP.
Two things, Sandeep. I think when you talk of per capita income, you should look at per capita income in purchasing power terms, parity terms. And there, I think we would not perhaps fare so badly, number one. Number two, even with these low per capita incomes, the fact is that India's saving to GDP ratio is much higher than that of comparable other countries. So, since investments are made out of savings, in fact, most of the investment is made out of savings. Foreign direct investment is important, but that's always at the margin. So, given that, I think both these factors should, in fact, work to India's favor. And as I said once again, a large young population is a huge demographic dividend, because we have a large percentage of our population within the productive age group, and these are people who are going to add value in future, unlike Western countries, unlike a country like Japan, which has a huge aging problem. So, I think these things, it's all a question of whether you want to look at the glass as half empty or as half full. So, you can look at exactly the same data and come to conclusion A or to conclusion B. So, it is definitely true, I would think, that S&P has opted to take a very conservative view of India. This is not to say that everything is hunky-dory, but as compared to how we were in the past, we are definitely much better off. How we are as compared to many of our peers, again, we are much better off. We are a democracy. So, unlike say in the case of China, there is, as I say, the political valve you have, it's like a pressure cooker. Anytime there's unhappiness with the government, you can vote the government out, you can protest. Unlike in the case of China, one doesn't know what's going to happen, when that society is going to implode. You also do not know how seriously you can take the numbers that the Chinese government puts out. What is the authenticity? How are they? Can you count on them? At the same time, rating agencies have looked much more kindly towards China than towards India. So, I think it's a bit of how you would like to look at what kind of prism you're looking through when you come to rating. And again, let me just conclude with the last thing. Recently, Argentina was downgraded by the rating agencies, and soon after that, Argentina went to the international market and raised money at a very low rate of interest, relatively speaking. So, I think one ultimately must go by what the market decides. Yes, rating agencies are important. It's good if you get a good rating, but if you don't get a very good rating, it's not the end of the world. The heavens are not going to crash.
No, I will definitely take that point with Ravi Bhatia a little later in the show. But Anant, I want you to come back on the point that we were discussing, which is the per capita GDP and how, between us and Indonesia or us and China, there's always been a mismatch. And to take Maitri's point forward, you can look at the glass half empty or the glass half full. How do you choose to look at it?
No, look, I'm guessing that the reason why the rating agencies put some, weightage to the per capita income is they see it as a measure of how much, if things were to go bad, how much can you actually crimp and save, and what capacity do you therefore have to deliver during tight conditions. So if you have a stress scenario, and if you're a high per capita income country, you could argue, I guess, that therefore the capacity for them to save a little more and live through tough times in a frugal manner is a little more than a country which is already cut to the bone and doesn't therefore have too much of capacity. I think that's, if that is the logic, it's fallacious, because as Maithili rightly points out, our savings rate and savings rate for developing countries in general tends to be a lot higher. And B, I would argue, looking at anecdotally across the global space, if you see a Greece, for instance, clearly the capacity for them to go frugal was tested and they fell short. Whereas I would argue that given our history of never having defaulted or even having thought about defaulting on our debt, including during extremely stressful times like the Gulf War of 1991, I would think that our capacity to actually go frugal and go through stress with completely adhering to and not giving up on our ability or willingness to pay, I think is a lot higher. So that argument, I think, is possibly not very fair. Having said that, it's a model that they use consistently across all countries. People are aware of this. People do their own analysis. And I agree with Maithili. I think end of the day, what matters is what markets eventually put as value. And in today's market, with all this wall of liquidity flushing in everywhere, frankly, all credit spreads are at all-time lows. And that really doesn't make a difference to us, the rating agencies themselves.
Indeed. We do want to address each of these reasons cited by S&P for maintaining its rating on India, and then we'll talk about how markets are looking at it in just a bit. But Ravi, the other point is that gets cited a lot is India's debt to GDP ratio being very high and being one of the reasons why you're cautious as far as your outlook on India is concerned. But again, India's debt to GDP ratio is nowhere close to developed countries like US or Japan. I mean, Japan at over 240%, US at over 100%, whereas India is still about 66 odd percent. So, and like Maithili pointed out a short while ago, our debt is entirely domestic. So, does this whole argument of high debt that is cited by S&P, does it really hold any water?
Well, I mean, for a developing country with the GDP per capita levels that India's at, and looking overall, I mean, the debt stocks are still high, and also interest payments as a percentage of revenues are high, are still quite high. So it's a combination of factors there, and also, I mean, we're still, even though there's this what called fiscal glide path. I mean, the fiscal deficits are still sizable if you combine the states and the federal level together, and we look at the change in debt. I mean, on a consolidated basis, fiscal deficits are still high, and debt stocks are still sizable. But yes, as you say, most of the issuance is in domestic currency with fairly long tenors, and that's something we consider. And that broadly is a good thing from a debt point of view, but no getting away from the fact that the debt stocks are high.
So no getting away from the fact that the debt stocks are high, and even though most of it is domestic, it doesn't quite cut ice with the S&P. Maithili, I know you completely disagree with that, don't you?
Oh, well, yes, I agree. Our fiscal deficit could be lower, but I think what is important is not just a number per se, Supriya. What is important is what that money is being borrowed for. Fiscal deficit is financed out of borrowings, unlike in the past we were printing money. Now, if this borrowing is being used for productive purposes, then there are positive spin-offs, positive externalities, as economists like to call it. And so I think what you need to focus not on the number, but the quality of the fiscal deficit. And as long as the quality of the fiscal deficit is improving, I'm not saying it's good, we still have a sizable revenue deficit which the government is committed to bringing down. So what is important is what you use that money for. It's one thing to borrow and go on a drink and have a binge at the bar, and the next day all you have is a hangover. But it's another thing to borrow and invest in a road, a bridge, a power plant. So that's very, very different. You cannot compare the two. Both are fiscal deficits. One is being used for productive purposes and one is perhaps being just frittered away. So I think it's important that rating agencies also look at what the money is being used for. And I think they don't make that fine distinction. And that is where I think they err.
Anant, a word on the fiscal deficit, because again, S&P, and this is something that even Moody's has pointed out, is the concern is not just, and I think we in the media tend to obsess a lot about the fiscal deficit number of the central government, but the bigger concern is what's happening with the states. And if you look at the combined fiscal deficit, then there is a fair cause of concern. So do you believe that the concerns raised by S&P, both on the overall debt and specifically when it comes to the fiscal deficit of both the center and the states, are they overdone, or do you think that they are legitimate in raising these concerns and these red flags?
I think they are legitimate issues to discuss, not just for rating agencies, but for us as well as stakeholders in our country. The reality is, in the past, when we have slipped up on the fiscal side, for very good reasons, after the crisis when we said, we're going to depart from FRBM and give a fillip to the economy. And that was a time when, by the way, gross fixed capital formation in the economy was doing reasonably well. Money was supposedly going into infrastructure, etc. And we know the consequences of that. We were left with twin deficits. We came to a situation where post the Bernanke taper tantrum, our markets went into a tizzy. The starting point being that we started to slip up on the fiscal front, and that impacted the external front as well. So there is definitely need for us to be very careful about how we manage our fisc. And to Maithili's point that, if we were to deploy the fisc into productive capacity building or education or good infrastructure, all that is great. But the reality also is that our credibility in managing these kind of investments is still pretty low. Hopefully this government will change that for the better over the next few years. But as things stand right now, there will be a lot of eyebrows raised if we start to slip on the fisc in a big way, with the pretext that we are actually going to invest into infrastructure at a time when private sector investment is low. Make no mistake, it's required. I do think fisc needs to be counter-cyclical, particularly when the rest of the macroeconomic variables are looking under control, for us to be able to foster infrastructure and get employment in place. But again, the credibility is pretty low. Now, the last bit on the fisc, look, a lot of the gains that we've had both on the external front and on the fiscal front is also, let's not forget, the tailwinds that we've had from low commodity prices, specifically low oil prices, and the fact that the government has done a good job of managing food prices. Now, as things stand right now, while there is still no real cause of big concern, there are question marks and higher degrees of uncertainty right now than we had, let's say, 6 months ago or a year ago. We don't know how geopolitics is going to play out. Oil is already at the upper end of where we thought it will be, in fact, gone beyond some people's estimates already. Food prices at an election year, can the government really afford to keep food prices controlled the way they have over the last few years? So there are plenty of question marks over the fisc at a time when we still have uncertainty on the bank NPAs, how actually GST is playing out for the SMEs and for the unorganized sector, how employment is looking at. So there are uncertainties that we have to grapple with, and these kind of indicators we have to watch very closely and make sure it doesn't slip up.
Okay, Ravi, I'm going to come to you, and I'll take the point that Anant raised forward, which is really about the credibility. Yes, fiscal deficit is a key factor at play, but why is there no consideration that is always given to quality of fiscal deficit, especially of late? I mean, what is the government borrowing for? It is not borrowing to pay higher subsidies or, foot the pension bills or put more money in HR. It's actually doing all of that to invest more via infrastructure, to invest more via the public sector engines of growth. Why has that consideration not been given to the quality of fiscal deficit in India?
Well, I mean, we have considered the whole reform effort, and we see the benefits of that in the strong growth story. And we mentioned the bank recapitalization, and have said broadly most of the reforms that have been done are positive and in the right direction. So we're looking at them broadly in that vein. I mean, on the fiscal, well, yes, there's been some of it has been good, some of it not so good. I mean, if you look at the state level, there's the issue around farm loan waivers, where they've actually had to cut back for example, in UP on health and other factors to compensate for that. So it's not all what you would call investment spending, which would generate higher growth. So it's a mixed bag, but we're considered it, and we're looking at it in the context alongside everything else.
Okay, Maithili, I want to bring it back to a point that you raised in your first answer, which is on, do these ratings really matter? Given the surge of foreign fund flows that we've seen in the country, do they really matter to asset prices in India? Why, if not, then why does everyone make such a big song and dance about it? Why is the government obsessed about it? Why have we sort of repeatedly tried to woo rating agencies to give us an upgrade, whether it's a UPA government or an NDA government? Do they really matter?
Well, yes, I think we do allow rating agencies to matter more than they should, because frankly, with apologies to Ravi and at cost of sounding rather rude, I think the credibility of rating agencies is pretty low to begin with. Because if you remember, immediately after the global financial crisis, rating agencies successively downgraded various countries much after the market had already pronounced a judgment on them and written off these countries virtually. So the credibility and the stock of the rating agencies was really, really low. So I think today nobody takes rating agencies very seriously, but at the same time, I think they matter at the margin. So even though the market would be the final decider and the market will decide how seriously it wants to take the rating or not, but the fact is that if you get a good rating, it is like a pat on the back from a relatively, we hope, independent authority. So to the extent that they matter at the margin. But frankly, the credibility of rating agencies is now rock bottom. In fact, which is why even the US SEC took very strong action against all the rating agencies, particularly S&P, because it was very unhappy with the way S&P rolled out, the riot act, as it were, to the US government. So by and large, I think rating agencies need to work on their own credibility, for that matter. sorry, Ravi, my apologies to you, but that is the fact, that is how things are today. And I think the US SEC has done a great deal to try and improve the surveillance of rating agencies. But yet, at the bottom line is that the markets, while they don't entirely dismiss the rating agencies, it does help if you get a positive rating. So to that extent, I think all governments, and particularly governments like ours, are very sensitive to the kind of ratings we get.
Oh, indeed. And Maithili has already tendered an apology for sounding rude if she at all has. But Ravi, just to take the point forward that she's making, that irrespective of what ratings there are, look at the kind of surge in foreign inflows into our markets despite our ratings at BBB minus. I mean, what explains that?
Well, first, I mean, you use the word despite, but you know, it's a high rating. It's in investment grade, which is investment grade is considered are considered all strong ratings. And then on your other point, I mean, you know, we look at the fundamental analysis. We look at from a broad picture, macro picture. And the market can deviate from us for various reasons, you know, also relative pricing compared to other EMs, etc. But we look at a fundamental basis, and you know, that's our assessment. You know, what we're seeing is that ratings continue to be very relevant to the market, etc.
Fair indeed. Ananta, probably let you have the last word on the debate then. Is there a bit of disconnect between rating agencies and the market, or is there a bigger disconnect between the market and the real economy?
I think all of the above, really, Sandeep. So look, reality is rating agencies, as I mentioned at the beginning, have kind of been a lot more conservative than the market. And there are a variety of reasons. It's also, as I mentioned, the fact that there's a scarcity value of India paper in global markets, and therefore we do command a premium compared to our peers similarly rated. So there is a dichotomy between what we command in the market, between what traditionally rating agencies have afforded to us. Second, the rating agencies' verdict does make a difference even today. Much as we might revile them and say that, you know, it's after all fundamental analysis, it's a view and all of that, the reality is a lot of real investors globally do look at ratings very closely. And while they do their own analysis as well, they also rely on the top rating agencies, and they have norms based on the rating agencies' actual verdicts on how much money they can allocate to a particular asset class or a particular country. So they are very, very relevant. Third, I would just refer to what happened on the day when the Moody's came out with a surprise upgrade. Really, the timing was a surprise. While they always had an outlook on positive, the timing clearly was a surprise that Friday. We did see our stock markets go up. We did see all our asset classes rally. We did see our overseas credit spreads come down and narrow by 5 to 7 basis points. We did see issuances coming out from Indian corporates and sovereign entities, which actually raised at better than expected market. So there is an impact immediately. Now, what tends to happen is when the mood is already positive, if you see something as a bit of a positive surprise coming in from any quarter, and this was definitely a positive surprise at that point in time, it just feeds into the frenzy that you already have, which is what was happening at this point in time. So with a wall of liquidity already propping up our domestic markets and our global markets globally, I think any positive, you know, like the Moody's upgrade was welcome. I think the market was half hoping for a positive surprise from Ravi as well today. But while that might be a bit of a disappointment over the weekend, and you might see a bit of a reaction on Monday morning, I think the wall of liquidity continues, and we will see, you know, markets continue to go in the happy pace they have been. Questions remain about where the real economy is versus where the markets are, and that dichotomy can remain for many quarters. And hopefully when the GDP data comes out, when the fiscal numbers come out, we'll have more clarity on this divergence, and hopefully they'll start to converge at some stage.
We'll start to converge at some stage. Ananta, Ravi, Maithili, we'll leave it at that. Thank you so much for joining us on that fascinating debate on ET Now at the India development debate. A week ago, exactly last Friday, we were celebrating a Moody's upgrade. Tonight, we are lamenting S&P status quo on interest rates. They say a week is a long time in politics. Clearly, a week is a long time when it comes to policy and economics as well, isn't it? So while ratings may not matter much to the markets, they certainly do matter to the economy at large. And we would have loved an upgrade for sure from S&P. Supriya?
Oh, absolutely, we would have, but I also think it gives the government a chance to look inwards and focus on reforms that would perhaps attract a ratings upgrade next year, and that's what reforms in progress are all about. Keeping our fingers crossed for many more structural reforms for the Indian economy, which will not just get us a ratings upgrade, but which will actually make us a more prosperous nation, and prosperity for all eventually is what matters, as S&P today commented. But on that note, completely out of time on this edition of the India Development Debate. Up next is Top 10 at 10 with Tanya Bharadwaj.
Keep it with me, Tina. Thanks.